Now, I absolutely love these events because I get to see real people and I get to see real customers. Those of you who came to our customer event in Manchester last year, I talked about tax. I picked the best subjects, I think. I talked all about tax and I had horrendous cold, maybe even flu, so I didn't hang around too much afterwards. I am going to be here until and over lunch if you'd like to chat about this cheery subject further. So yes, I have taken kind of full liberty with the fact that you guys are here to talk, hopefully, about pensions and retirement. I normally get groans from my kind of friends and family when I start getting on my high horse about all things pension. So I've really taken liberties, and I am going to start off with the cheery subject about what happens to my pension when I die. And the reason I have picked this, not just to be awkward, is it's the reason what I'm saying. The reason I picked this topic is actually it's one of the most frequently asked questions we get either on the podcast, from your feedback on the articles and content that we write for you. So you've asked for it, and here it comes. Right. What am I going to cover today? So I'm going to cover the kind of the who and the how, okay? So we're going to talk about who can benefit from your pension, and then how they might be able to access that money, anything that's left in your pot, and then the tax treatment for them. So death and taxes, lovely. And the one that you might be here for, or you might have heard about, there's been a lot about it in the press, is I'm going to touch on the proposals to bring unused pension pots into people's estate for IHT. Right, so for my kind of 17 minutes. So let's start off with the who. I've got two kind of terms up on every single screen here. We've got dependent and nominee. Dependent is something that is defined in the pension scheme rules. It's defined in pensions tax legislation as well. So a dependent is somebody who can automatically be eligible to benefit from anything that's left behind in your pension pot after you pass away. It doesn't always mean they'll automatically get paid it, but they are automatically eligible regardless of whether they've kind of been nominated by you or not. And I'll come on to nominations in a second. So there are various categories of people who do meet the definition of a dependent. First one's up, quite easy to identify, so someone you're married to or in a civil partnership with. Very easy to evidence as well. The second one is a child of yours under 23. We sometimes get asked, does this apply to grandchildren? It is just children here. So again, those two, very easy to evidence. Then we get on to older children who might be dependent because of a physical or mental impairment. And finally, someone who is financially dependent on you, or you're in a relationship of what we call mutual dependence. Now, it's important to note that a spouse and children under 23, those people who are automatically dependents, that isn't contingent on whether they sort of have their own, financial pots, whether they're financially secure in their own right. They are automatically dependent, regardless of their wider circumstances. Now, this can create some interesting things sometimes, because you might actually have a child over 23 who's still living at home, and they're very much dependent on you. It's likely that they would fall into that financially dependent fourth bullet point there. But obviously it's something that is a little bit more difficult to evidence than a kind of hard marriage certificate. Just a word on whether you live with an unmarried partner. Obviously lots of people these days choose not to get married or enter a civil partnership. That partner would not automatically be a dependent unless you can evidence some of the financial dependence, or you're in this relationship of mutual dependence that we talk about. So it might not be like quite like binary, that one of you is dependent financially on the other, but your finances are likely to be intertwined. So for example, you have a joint account, you have a joint mortgage. If something happened to one of you, it would upset your sort of family finances as you like, but you're not kind of obviously dependent on each other. So we, as trustees, when we're looking at who is dependent of our pension scheme members, we will need to maybe ask for some evidence of the financial dependence or that kind of mutual dependence. Now, the second point on that, the second one is nominee. So that's anyone nominated by you to benefit potentially from your pension savings. So the obvious people here, not a recommendation, but to think about nominating would be your partner that you live with if you're not married, any older children you might want to consider benefiting from anything that's left in your pension pot, and grandchildren. But it can actually be anybody. You can nominate whoever you like, and you can even nominate trusts and charities as well. So PowerPoint, clearly not one of my skills. I'm not quite sure what I was doing with this border here. But how do you nominate someone? You tell your pension provider. So they might have a paper form, or you might be able to do it online. So behind me or over here is an example of how you can do it with your AJB pension. Now, we will nag you for it when you first take a pension out with us. When you first open an account, we'll likely give you a nudge if you come to access your pension pot when you're thinking about drawing down on that money. But it's really, really important it's kept up to date. So where is it in your account? So if you log into your account, it's in the My Account, Update My Details section. Have I got a, oh, no, I do have a little pointer, but it's not going to really work for everybody else. It's in the pension beneficiary section, and you'll see here, you can just add as many beneficiaries as you like. The only rule we've got on this screen is that it adds up to 100%. Okay, so we would take their name, your relationship, so it could be spouse, civil partner, it could be child, it could be friend. We can take type. Now here, type is either whether it's a person or whether it's a trust or a charity, and then the percentage that you'd like us to consider them benefiting from. So as I say, it just needs to add up to 100%. You can have multiple beneficiaries, you can have some people, you can have a trust or a charity as well, but as long as it adds up to 100%. Okay. Oh, no, I'm going the wrong way here. This is not going to plan. Right, so why is it important that we have nominations? Well, life is busy, things change, okay? So, like I said, we ask when you first open an account with us. Maybe not all providers do that, and again, when you come to access. But it's because we need to know who you'd like to potentially benefit from your plan. And that's because pension pots like SIPs, or personal pensions, ready-made pensions, if you have one of our newest accounts, we as trustees have discretion. Now sometimes that puts the fear into people. They think, well, what on earth do you need that for? I want to tell you who should benefit from my pension pot. But it's really important that the trustees maintain discretion for reasons I'll come on to in a second. The first one, at the moment, it means that the pension pot would fall outside of your estate. So a trustee is having discretion because that pension pot is held under trust, means that it, until potentially April 2027, will remain outside of your estate. But there's other really important reasons as well. So the nomination that you give us is telling us your wishes, expression of wish. It isn't binding, and again, that feeds through to that kind of current IHT exemption. But life is busy, things change, your circumstances change, relationships change, new children, new grandchildren arrive, relationships break down. But the nomination is the first thing, should the worst happen to you, that we look at when we are exercising our discretion as trustees. We also look at your will and any other information to help us get the clearest picture of who is perhaps dependent on you, who you would like to benefit from your assets. Now, lots of people sometimes mention their pension in their will. It can be helpful, but it doesn't really mean anything. Your will does not govern your pension like it does other assets in your estate. So it is all about this nomination to tell us who you want to benefit. Now, why else is discretion important? Well, with some kind of wealth planning and potentially estate planning, you might nominate your spouse, and we will always consider dependents first. It's our trustee duty, if you like, to make sure that dependents are catered for and financially secure. But your spouse might say, well, actually, I've got pensions of my own, I've got assets of my own, I don't need 100% of that pension. So what we can do with discretion, if they can show us that they are financially secure in their own rights, they might want to forego some of that pension. They might say, actually, can I just have 50%? And can you consider my children for the other 50%? And if we have, because we've got discretion, as long as we can check that they are financially secure, that is an option. We can consider then actually allocating half of that pot to children. Conversely, on the other side of the coin, you might have thought ahead of this and nominated, let's say, 2 children or 2 grandchildren, 50-50. You haven't mentioned your spouse or your civil partner. When we come to look at your pot and exercise our discretion, if your spouse is still alive, we will need to just check with them that they are financially secure and say, hey, just so you know, your partner, your spouse has said that they wish for this pension pot to go to your children, are you financially secure if we do follow that wish automatically? So it's just about giving that maximum flexibility, making sure that we can take your wishes into account. And if something has changed, perhaps you've got divorced, perhaps you split up from your partner, we can double check your circumstances with your personal representatives, your executors as well, just to check we are paying to the right people. So it's not designed to scare you. I think sometimes people can think, oh my goodness, I want my pension money to go to this person. 99% of the time, we follow the nomination. There's no need to kind of veer off of that at all. It's all about just gathering information and checking and making sure we're paying to the right people, not someone that your relationship perhaps ended 10 years ago. Please keep those nominations up to date as well. You guys are all here, you're all engaged with your finances, I think, or you're looking to become more engaged with them. We've got lots of customers who aren't as engaged as you. Life is busy, I keep coming back to that point. Just please remember to keep those nominations up to date, whether they're with AJB or any other provider. My kind of top tip is to, if you are someone who likes to keep an eye on your portfolio, you might only look at it once every 2 years, maybe you do it a bit more often. Just have a think, to have it as part of your kind of checklist, your little financial housekeeping, to check those nominations. It also gives your beneficiaries more flexibility in how they can take the money, which I'll come on to in a second. So what can be paid? Once we've gone through this process, we've exercised our discretion, your beneficiaries have been selected, how can they take the money? Well, individual beneficiaries can choose from a number of options. There's a lump sum. They can move it into a pension in their own name to draw income. So they can kind of do that as and when they want it. Or they can do a combination of the two. So they might have something that they really want to fund, I don't know, buying a house, a wedding, a big trip, whatever, and then the rest they're going to use to provide themselves with an income. One question that comes up quite a lot, or people try and write in their expression of wish letters if they want to give us a separate one, is they'd like to govern how their beneficiaries will take the money if they're awarded it. For example, I know what I was maybe like at 18 or 21. My parents probably wouldn't have been too mad about me getting my hands on a large lump sum. I mean, they didn't actually leave me any large lump sums, but there we go. You can't choose how your beneficiaries take the income. Even if it's the most sensible option from a million different reasons, tax reasons, it's the who that you get to nominate, not the how. And when I do see people sort of say, I only want them to take an income. If it's really important for you to be able to have some control from kind of beyond the grave as to how that money is taken, speak to a financial advisor potentially about some kind of trust solutions, but that's out of the scope for today. As I mentioned before, you can have multiple beneficiaries, okay? It doesn't have to just be one. And for your trusts or your charities, if you do choose to leave any money to them, they can only take that as a lump sum. Now, our nomination form, the reason I keep banging on about keeping nominations up to date, is designed to give your chosen beneficiaries the flexibility of all those options. So dependents can have all of those options that the individual beneficiaries can have. They can have a pension option automatically. But unless you nominate someone who doesn't fall into those dependent categories, there's a chance, particularly with other providers, that they might be restricted to the lump sum option. That can cause some tax planning issues a bit further down the line. So please keep them up to date, keep your nominations up to date. Now, beneficiary drawdown. It's a very jargony way of just saying, leaving it in a pension pot in their own name to take an income. It's great because they can take an income at any age. So if you've left your pot to a grandchild or a child, they don't have to wait to age 55 or age 57 from 2028 to take that money like they would their own pension pot. They can take it as and when they need it from any age. So if we're thinking about leaving it to grandchildren, perhaps school fees, university fees to children, again, access it before 55. It's not locked up. It's kept very separate to their own savings pot. It can be within one SIP, but it's just a separate, what we call arrangement. And again, taking income as a beneficiary from that beneficiary pot doesn't affect how much you can pay into your pension scheme going forward. So if you're a beneficiary, you take some of this income that's been left for you, it doesn't restrict your contributions going forward like taking income does from your own pot. Now the tax side of things. Lovely. If a pension member dies before age 75, usually any money that's left behind in their pensions can be taken by their beneficiaries tax-free. Now, there is a little limit, or it's not a little limit, it's just over £1 million limit. There is a little thing to be aware of. There is an allowance for tax-free lump sums that have taken in your lifetime and then taken by your beneficiaries on your death, okay? Like I mentioned, it's the kind of hangover from the old lifetime allowance. So should you die before 75, and perhaps you've left a big fund, or you had a big fund in your lifetime and you took large tax-free lump sums in your lifetime, just be aware that that limit might apply to them. But there is a way around that. If your beneficiaries did want access to kind of a chunky lump sum, tax-free, they could use it to move into a pension in their own name and then withdraw it all. So the only sticking point, apart from this lump sum and death benefit allowance, is that the pension funds need to be moved into the beneficiary's own name within 2 years. Most 9 times out of 10, that absolutely happens. We're in communication, we get that ball rolling. After 75, anything your beneficiaries take, whether they take it all out as a lump sum or they take a bit of income as and when, is taxed as income at their marginal rate. So just like our salaries, they could be paying no tax if they don't have any income, or it could be 20, some at 40 and even 45. If you had a large fund and they just took it all out as a lump sum if you died over 75. This is why keeping nominations up to date, having the flexibility for your beneficiaries to take an income is really important, because they can structure that around their own tax planning considerations, and it means that they're not going to pay a huge hefty tax bill just to benefit from your pension pot. There is the option as well, as I mentioned, to leave your pension fund to charity. You can do that by nominating a charity, but there is a special type of lump sum that is completely tax-free and will remain free of inheritance tax under the new proposals. It's called a charity lump sum death benefit. I'll just quickly run through this. We've got some good content on the website about it, if it's something that interests you. And it needs to meet certain rules to be this special lump sum. So you have no dependents. You've nominated the charity. Now, there's no limit, as I say. There's none of this lump sum death benefit allowance limit, and it's completely tax-free. If you wanted to do that charity lump sum, I'm giving you a preview of what I want to do in a second, and you have a dependent, for example, you can still nominate a charity, it just will fall into those tax rules that I explained earlier. Right, onto the bit that some of you guys might be here for. Now, it's probably no surprise to you that her first budget on the 30th of October last year, Rachel Reeves announced that she wanted to bring pensions into people's estates to be able to charge inheritance tax on them above the usual limits. Now, this consultation had over 500 responses, which is completely unheard of in our world. Normally people don't get very excited about pension stuff, particularly technical consultations, but I think it gives us an idea of the strength of feeling, not great feeling, behind the proposals. They are still very much proposals. We haven't heard anything since the consultation closed in January. We are awaiting and expecting some draft rules. I don't know if anything's going to change. We are expecting some kind of death tax to be levied on unused pension pots, I'm afraid. We're just hoping and praying that at the very least the mechanism that they've proposed changes, because it's very difficult for pension providers, and it's going to have a really bad knock-on effect for your beneficiaries beyond the actual tax implications. Now, I will say around about 5% of estates, that's 28,000 estates, are subject to IHT or have to pay some IHT each year. The government estimates that these proposals will increase that to 8%. Personally, I think that's maybe under-egging a bit slightly, but it's still an indication that although it's alarmed nearly everybody, it's not going to necessarily impact everybody, okay? So I'm going to go through what we know so far, but please don't panic, don't make any rash decisions. Once we know what the rules are going to look like, what the draft rules look like, we will be communicating with customers and we will analyse and digest them. So the proposed changes from 6th of April 2027 are that unused pension pots are to be included in people's estates. The only real exception to this at this stage is if you have a final salary or defined benefit scheme, and that pays out what's called a scheme pension to your beneficiaries, that would not be included, but most other pensions at the moment are in scope. However, usual IHT rules, such as spousal exemptions or civil partner exemptions, do apply. So anything you left to your spouse or civil partner would not be included in any estate until second death. With that, everybody still has a nil rate band of £325,000 per person. Again, that can be transferred to a spouse or civil partner. And if you are leaving property in your estate to something known as direct descendants, you might have access to another nil rate band. But again, that depends on the value of your estate, and that's kind of out of scope for today. So my kind of message here is, we're waiting and seeing. Please don't panic. Please don't make any rash decisions just now until we know exactly what we are dealing with. The important distinction here with pensions, because we're obviously used to pensions not being included in people's estates, is that they can normally be distributed out to your beneficiaries quite quickly. We don't have to wait for the probate process. That's one of the biggest concerns we've got about the proposals beyond the tax itself, is that it will fall into that probate process. And it wasn't 1 or 2 years ago that the probate service was suffering horrendous delays. So it really, at the moment, the proposal is to take IHT from the pension in proportion to the value of the assets in the rest of the estate first, before it is distributed. Then your beneficiaries, if you did pass away after age 75, might have to pay income tax on anything they withdraw as well. So you've seen it in the news, perhaps referred to as a double whammy. It won't affect everybody if the proposals come in as planned, but it's just worth bearing in mind. I've done a little case study. You'll find it on our website. There is an article that goes through this, but just to kind of illustrate that effect. Now, I picked Colin. He's single and dies aged 81. He has £200,000 left in his SIP and £500,000 in his wider estate, including his property. So at the moment, IHT of around 70,000 would be payable. That £200,000 can be distributed from his SIP, but his beneficiaries would pay income tax as and when they take the withdrawals from what they are awarded. Potentially on or after the 6th of April 2027, if he died after that date, you can see the effect of bringing the pension into tax. So IHT bill jumps by more than doubles to £150,000. The proportion to be taken from the pension is just over 42. That leaves less to be distributed to his beneficiaries, and because Colin died after age 75, they would then pay income tax on their share as and when they take it out. So just to kind of give a flavour, that is an extreme example. Obviously, Colin didn't have a spouse or civil partner, but it's just to kind of show the magnitude for some people. And again, like I say, there is the article on our website for you to go through that at your kind of own leisure. Now, I did say don't panic, don't take any rash actions, but when we do talk about this topic, we get asked a lot, okay, but I want to maybe think about turning that income tap on my pension to kind of start to bring forward gifts in my lifetime. I plan to leave stuff to my children, grandchildren, other family members, but I want to bring that forward. Actually, I can potentially enjoy the benefit of them getting that gift whilst I'm still alive. There is one way to do it. Again, it's for people who perhaps don't need that pension income. You will pay tax on what you withdraw from your pension, but there are ways to kind of bring forward those gifts now. And one kind of neat way of doing things is, say you take income from your pension, you pay tax on that to get it in your hands, but then you gift it to your beneficiaries or to whoever you like. If they then use that money to pay into a pension in their own name, they get tax relief, and kind of the net effect sort of wipes out that tax coming out, and they get tax relief back on the way in, and obviously a nice boost to their pension pot. They can't get at that until they're age 55 as well. So there are ways of kind of passing down wealth if you think this is something that's going to apply to you. But as I say, try not to make any rash decisions right now. It gets very complicated. The rules on keeping these gifts free of IHT get complicated. So it's potentially one to really think about talking to a financial advisor about. Okay. And as I say, that article is straight from our website. So if you want to have a look, just to kind of get a feel for things, please do so. So in summary, I know I've probably run slightly over time here. You can nominate whoever you like, an adult, child, trust, charity, a combination of all of those. Your beneficiaries choose the form of the death benefits, okay? They choose the how, lump sum, income, mix of both. Please, please, please keep your nominations up to date. And yes, IHT could be coming from April 2027. My usual disclaimer. But thank you very much for your time. Enjoy the rest of the day.
Charlene, thank you very much.
Okay.